Hi everyone, Michael Scott here with Candor Financial, and today I'm coming to you with a little bit of a first quarter market update. First quarter for many investors was a little bit head scratching. The year began with COVID at the front of the headlines, and as that faded into the background, the Russian-Ukraine crisis took hold. And as that dominated the headlines for the next couple of weeks, many investors began wondering what's next, what's going to happen from here in the markets and in the economy. And to really answer that question, we need to look at what happened in the first quarter and what could happen moving forward. 2022 began with a strong economic backdrop. The fundamentals in the economy were really good for us. There was low unemployment, there was low interest rates, consumer spending was very strong, and more importantly at this point, Omicron was beginning to fade. While being highly infectious, it came with less severity than previous strains, and that was important. The economy can continue opening up and continue accelerating. So the market was set for potentially a good year as well. Unfortunately, that's not exactly what happened. January began with a bit of volatility and kind of turned into a healthy correction. The markets began to stage a rebound moving into February, and that was going well until Russian-Ukraine crisis exploded onto the scene. With the US and its allies sanctioning Russia, there was a lot of concern and the market began to sell off. Oil spiked up to nearly $130 a barrel at one point. The Federal Reserve began hiking interest rates for the first time in several years, and there was going to be fear about a third world war if NATO and Russia collided. Fortunately for all of us, a lot of those fears abated and the markets began to rebound. By mid-March, the markets were staging a rebound and coming off of their lows. To end the quarter, the Dow and the S&P were only down about 3%, and the NASDAQ was down about 8%. Really good looking back at where they were to start the year, but also not ideal. So many investors are wondering moving forward what's going to happen and what can be expected. Unfortunately, timing the market and answering that question is very difficult to do. So what we wanted to do was take a look at two possibilities. One, the market going up, and two, what would it take for the market to continue going down. So first, let's look at the bad news. What could potentially keep the market from going up? The easy answer here, and the one that many people probably expect, is the Russian-Ukraine crisis. And while that's really important for the market, that's actually one piece of a larger problem, and that larger problem is inflation. Inflation is simply the rising cost of goods and services in the economy. I'm sure you've noticed, as many Americans have across the US, the prices of homes, the prices of energy, the prices of food, rent, automobiles. It seems like the prices we pay for everything has gone up. And that's primarily due to businesses. And that's because as businesses see their prices going up, they try and pass that on to consumers. So the question becomes, what would it cause the economy to go down? The worry is that as consumers see these prices rise, they begin to pull back and they buy less, or they make changes in their purchasing behavior. If that happens and consumer spending drops, the economy could suffer. And if the economy suffers, the market could pull back a little bit. And now for the good news is that walking into the situation with inflation, US consumers seem pretty resilient at the moment. We go back to 2020 and what happened with COVID. And you look at all the measures that the federal government put in place, politics aside, they set up the consumer really well. The payroll protection program kept a lot of people employed, stimulus checks worked their way through the economy and kept consumer spending up, and other measures allowed US consumers to avoid taking on a lot of debt that could have become crippling. Additionally, overall, the past 10 years have been great to equity investors. We've seen household wealth rise across the US, and even more so, we're seeing wages rise for a lot of workers across the country. And that's an extremely good thing. And so far, it seems like the US consumer is having no problem or very little problem dealing with higher inflation. And if that trend continues, the markets could continue to go up, and that would be a good thing for everyone. So what should you do at this point? The main thing to remember is that sticking to your financial plan is the most important thing. If your financial plan is put in place correctly, it should take care of up markets and down markets. If the market goes down, look at it as a buying opportunity. You could shift more money from cash to stocks or bonds to stocks and take advantage of a market dip. If the market goes up, everyone's winning and there's nothing to be concerned about. If you have questions about your financial plan or concerned that it may not be built for both markets, contact your advisor or talk to one of us at Candor. We'll see how we can help you.